Stick to your investment strategy, especially in uncertain times. Uncertainty is a constant companion in the world of investing, frequently brought on by changes in market sentiment, geopolitical events, or economic fluctuations. It can be tempting to stray from a tried and true investing strategy in these turbulent times out of fear or anxiety. But sticking to a disciplined plan is crucial for long-term success. You can overcome obstacles and reach your financial objectives by adhering to your investment plan. This video provides insights on how to stay the course even when the market gets rocky by thoroughly examining these fundamental ideas. Number 5. Importance of staying calm. One of the most important abilities an investor can have is the ability to remain composed in the face of market volatility, particularly in periods of increased uncertainty. It is normal for investors to experience a range of emotions during large market fluctuations, from excitement and greed to fear and anxiety. These feelings have the potential to set off impulsive decisions that could compromise long-term financial objectives. Fear may lead investors to sell assets at a loss or pursue speculative opportunities that are out of line with their investment goals or risk tolerance. Giving into these emotional cravings, however, is frequently a surefire way to go wrong because it can lead to locking in losses, losing out on possible gains, and deviating from the well-thought-out investment strategy that was meticulously created to meet predetermined financial goals. Investors can approach the situation logically and concentrate on the foundations of their investments rather than letting short-term market fluctuations influence them if they remain composed and focused. This way of thinking keeps things in perspective by serving as a helpful reminder to investors that market volatility is a natural part of the investing process and that overreacting can backfire. Even in the face of market volatility, investors can support their long-term financial goals by remaining composed and making well-informed decisions. Ultimately, successful investors who can navigate difficult environments and come out stronger on the other side are those who can maintain their composure in the face of market turmoil. Number 4. Long-term perspective. Taking a long-term view is a potent remedy for the psychological distress that frequently accompanies market volatility. Markets are cyclical in nature, with periods of growth followed by periods of decline, as history has repeatedly demonstrated. Long-term trends, however, have generally indicated an upward trend, with markets rising from slumps to record highs. The ability of businesses to adapt and prosper in the face of adversity, as well as the resilience of the global economy, is demonstrated by this pattern of recovery and growth. Long-term investors are more likely to stick to their investment plans and are less likely to become sidetracked by day-to-day fluctuations in price. This viewpoint promotes an emphasis on the underlying principles of their investments, such as the state of their own company's finances, the potential for industry growth, and the general economic conditions that influence market performance. Investors can weather brief downturns and eventually profit from the market's recovery and growth by viewing the big picture and staying dedicated to their long-term objectives. This long-term perspective is especially helpful in uncertain times because it keeps investors focused on their long-term financial goals and helps them avoid the traps of short-term thinking. It is crucial to remember that having a long-term view does not entail ignoring current market conditions or neglecting to modify one's investment strategy as needed. Instead, it entails keeping an impartial perspective that respects the cyclical nature of markets while remaining adaptable to shifting conditions. Investors can navigate the market's ups and downs with more resilience and confidence when they adopt a long-term perspective. Number 3. Diversification. A wise investing strategy must include diversification, especially during uncertain times. A single investment's risk can be decreased by investors by spreading their money across a variety of asset classes, including stocks, bonds, real estate, and commodities. Since various asset classes frequently react to economic conditions differently, this strategy helps to mitigate the impact of market volatility. Bonds, for instance, can offer stability and income in the event that stocks underperform, while alternative investments like real estate or commodities can help with diversification. Spreading your investments geographically and making investments in both domestic and foreign markets are further ways to achieve diversification. This strategy not only reduces risk, but also creates opportunities for returns from various economies and sectors. A well-diversified portfolio can offer investors a sense of security and stability during uncertain times, enabling them to stay focused on their long-term goals without being unduly exposed to the risks associated with any one asset class or market. It is crucial to remember that diversification does not provide protection against loss. As such, investors should continue to carefully consider the risks and possible rewards associated with each investment. To make sure that one's entire portfolio is in line with their risk tolerance and investing objectives, it is important to find a balance between risk and reward. By embracing diversification as a core principle of their investment strategy, investors can navigate uncertain times with greater confidence and resilience, knowing that their assets are spread across a range of investments that can help to mitigate the impact of market volatility. Number 2, patience and consistency. When it comes to investing, persistence and patience are crucial traits, particularly in times of market turbulence. Rapid market reaction tendencies can result in lost opportunities and monetary losses. Fear may cause investors to sell their assets at a loss, or the prospect of rapid returns may lead them to make speculative investments. These instinctive responses, however, are frequently ineffective since they can lead to locking in losses, missing out on possible gains, and deviating from the well-thought-out investment strategy that was meticulously created to meet predetermined financial goals. The effects of volatility can be mitigated by consistent investing, such as dollar-cost averaging, in which investors consistently invest a set amount regardless of market conditions. This method takes advantage of lower prices during downturns and lessens the chance of making bad decisions based on transient market movements. This methodical approach has the potential to significantly increase wealth over time. The important thing is to stick to the investment strategy and remember that even in the face of market fluctuations, real wealth creation frequently takes time and perseverance. When things are uncertain, investors who are patient and consistent are more likely to stick with their plan and resist the urge to make snap decisions that could endanger their long-term financial objectives. Investors who adopt these virtues will eventually benefit from their disciplined approach and be able to weather the storms of market volatility. It's crucial to remember, though, that patience and consistency do not equate to mindlessly adhering to a plan of action that is out of step with one's objectives or risk tolerance. In order to make sure they stay on course to meet their financial goals, investors should regularly review and modify their plans. Finding a balance between staying the course and adapting to changing circumstances is crucial, and you should always keep the long term in mind. Number 1, adaptability. An investor's ability to manage uncertainty can be improved by being flexible with shifting market conditions, even though adhering to a clearly defined investment strategy is still vital. Being flexible does not imply giving up on your investment beliefs. Rather, it means being willing to adjust your plan in light of fresh data or changing market conditions. An investor might, for example, think about modifying their bond holdings or looking into alternative investments that might do better in an environment where interest rates are rising if economic indicators point to a change in interest rates. Investors can maintain their relevance and responsiveness without sacrificing their long-term objectives thanks to this flexibility. Investors who incorporate adaptability into their investment strategy are able to take advantage of emerging opportunities while maintaining adherence to their core strategies. Finding the right balance between flexibility and consistency is crucial, though, as making frequent adjustments to your investment strategy may not provide the best outcomes. The secret is to keep an open mind, keep an eye on the state of the market, and only make changes when they are absolutely necessary to meet one's overall investing goals. Being adaptable as an investor also means being open to growing and learning. Investing best practices, market trends, and economic conditions can all help investors gain the information and expertise they need to make wise choices during uncertain times. To stay up to date on the most recent advancements in the investment industry, this may entail reading financial literature, attending educational seminars, or consulting a professional advisor. By embracing adaptability as a mindset, investors can navigate market challenges more effectively and position themselves for long-term success. At the same time, it is crucial to remember that adaptability should not come at the expense of one's core investment principles or long-term goals. The most successful investors are those who can strike a balance between sticking to their strategy and being responsive to changing circumstances, always with an eye toward achieving their financial objectives over the long term. In conclusion, during uncertain times, maintaining a disciplined approach to investing, focusing on long-term goals, diversifying your portfolio, and being patient can help navigate the challenges of the market effectively. Thanks for watching our video, and don't forget to subscribe to our YouTube channel.